but those are your first two earnings of the day.
What up, everyone? Welcome back to
Still don't have Rock Lab. Yeah, next, are we pumping on next? Next is not pumping.
Numbers are not looking too good here.
Next is flat.
But again, here's what a quick
Beyond Meat
headline I'll
is up
just
a
throw
little
out.
bit.
Paramount sees
Is Beyond Meat
2026.
today or is it tomorrow?
The after hours
Beyond Meat earnings is November 10th. No, it's today. It should be today. The conference call will be tomorrow. The earnings will be today. CoreWeave, are we moving? Are we moving? We got a 2% move. 3%, 3.1.
Your office apps not working together as a team.
Green continued, 3.5. CoreWeave again was at 140 a couple weeks ago. Now down to 105, so it definitely got hit.
A whole new collaborative world for your office apps.
I don't know how healthy that green candle is.
Zoho Workplace.
Immediate move up.
All right, there it is.
At Revive Design and Renovation,
CoreWeave right
design
here.
starts with connection.
You guys, 62% of you said
take
pump.
time to truly understand your
38%
lifestyle,
said
transforming
dumb.
your vision into reality.
From fun hands-on sessions in our showroom to stunning 3D designs.
With clear communication,
Third quarter
and a
revenue,
5-year
1.36
warranty,
billion
you can
versus
feel
1.29. That's
every
a
step of
beat
the
on
way.
revenue.
Revive Design and Renovation.
Where every detail
Beat
is
on
designed
EPS.
with
We
you
thought they
to
would lose
make
57
your
cents.
dream
They
a
only lost
reality.
22 cents. That's actually
Call us
really
today.
good. That's a hell of a beat. That's a beat by freaking 25% on EPS.
Pretty impressive.
Big Bear is up 3% after hours. Big Bear don't have the numbers yet, but that is moving. CoreWeave not getting a crazy move, but they did have a pretty nice. I mean, they're 20 cents away from profitability, which has been one of the biggest concerns with this company. CoreWeave right there up 4.5. Big Bear up 3%. EPS of 25%. That is a very strong beat on a capital. Dude, CoreWeave's capital intensive, so for them to inch out that margin, I'd be very curious to see what they did. But it's definitely something that I think the industry will be happy about. CoreWeave again beat by 57% and then beat by 7% on EPS.
So I don't know if they're gonna hit it, but it looks like Rocket.
Which is what we're looking at right here. Negative 22 cents versus 51 cents expected.
Quantum play here.
Next is reporting on October 30th.
Revenue. So this is your quantum business.
I'm gonna blame June for that. June, you told me Next was reporting today.
So far away right now that
Told me Next was reporting today, June.
these are there to make
Now you made me look stupid in front of Matt Money. That's his stock.
Significantly, which is pretty crazy.
But if Next already reported, then we don't focus on this. Rocket Lab right there, that's flat. ASTS, that's flat. Big Bear, I don't have their numbers yet.
They're Q2.
Don't have their numbers yet. CoreWeave, she's not holding it. She's not holding it.
I guess if anything,
Trying.
Bird catches the gaze. This is Morning Brief
down from
Market
4%,
Sunrise.
almost
Live
went
from
red.
London,
You
we
see that red
deliver an
candle right
early
there.
read on global markets. From overnight action in Asia
Rumble
to
acquires
real-time
Northern
sentiment
Data,
across
a big
Europe's
data
major
center
trading
player in the
desks
EU.
and
Are you
live
kidding me?
at US
Is
futures.
Rumble
We
about to
cover
get
the
into the
stories
data
to help
center
you,
space?
the
Oh
individual
my
investor,
goodness.
get the edge.
Rumble
Actionable
stock after
financial
hours
information
flat. It
and
was up 11%
unbeatable
on the day,
context.
though.
So grab that
Somebody
coffee,
knew that
tap
they were
in,
gonna announce
and
something.
let's own the morning.
Dude, if Rumble legit becomes a data center play. Is every company just realizing their business model suck and they're transitioning
Stocks
to data
rising
centers?
to
Is
start
that
the
what they're doing?
week. The Senate taking a big
Is that what's
step
going on?
toward
CoreWeave up
ending
2%.
more
Big Bear
government
still don't have the numbers yet on Big Bear.
Here with the train day takeaways, got Yahoo
Should be getting it soon.
Jared.
Josh, the big winner today, NVIDIA.
If not, then this
honestly.
2% move, I don't
And
know
there's
what
a
the street's
virtuous
reacting to
cycle
if we don't
going
have
on
numbers.
here. NVIDIA leads tech.
Big Bear, yeah.
Tech
TerraWolf
leads
again
the
missed by
NASDAQ,
2,000% on
maybe the
EPS.
NASDAQ
Rigetti missed by
circles around
933% on EPS. CoreWeave
we
beat
saw
by
is a lot of
57% on EPS. CoreWeave
outperformance
holding
by
on
tech today.
to a 2%.
And we're looking at the Dow here. 0.8% is not
He
nothing.
tried crypto, now it's
Here
data center.
is the NASDAQ composite. That is
Yeah,
up
I
2.25%.
mean, the Bitcoin mining
and that is the
business
best
obviously
day
never worked
since
out. You need
May.
Bitcoin miners.
So we're talking about 5 months here.
themselves.
And let me just show you what happened with the mega cap sector.
Data centers.
And especially
A lot of
there's
demand for
tech,
data
by the way,
centers. So, I mean, I think the pivot makes sense. The
2.57%
question is just the
readout.
quality of these companies.
Here is the NASDAQ
Getting into the
100.
pivot. CleanSpark got smashed today. CleanSpark. Wow, why is CleanSpark down 5% after hours, and why was it down?
Today? And that
Well, it
is
was down
the best
4%
day
in the day
since
because Iran was down.
and I believe it's
all the
April
other guys
9th,
were
April
down.
10th.
Iran
was a
after
huge
hours is
update that we
flat.
had after those
Cypher after
washout
hours is
lows.
flat.
And so
CleanSpark's
this is
still
kind of a
getting
big
hit. Did
deal
they
here.
dilute or something?
And it just
That's weird.
signals that NVIDIA, after that scary drop-off that we had just a few days ago, while I was out, by the
They
way,
did an offering? Okay,
it
of
has
course.
come
Of
roaring
course
back.
they
And
did.
so here we have the highs.
What's the
and
offering?
it's just
How much did they
starting
dilute by?
to flirt with 200 level, and we'll have to see if it skates above that. Nevertheless,
1 billion.
This is an area where shorts
1
would
billion in
logically
convertible
come in,
notes.
but if we surge above that tomorrow, I think it's
1
essential that we
billion in
take out these
convertible. That's what it
record
looks
highs.
like.
Nevertheless,
Yeah, just
a
now.
little bit of vulnerability
Literally
there.
at 4:02
But
p.m.
given
they
what's
put up
happened over
this,
the last two
press
trading
release.
days, that big
Do
kind of
2032,
1 billion
in
Friday
convertible notes.
combined with today's uptrend, I think that kind of
I remember when
cements
they were Bitcoin
this
mining,
new
they were doing
short-term
just
rally that
regular
we're
Bitcoin,
seeing
so
here.
they definitely
So
have a lot of
logically, my
open
next
convertible notes.
step here is to go to
On the
gold.
balance sheet,
because
Clean Spark right there
they
down
also had a big day.
5.3%.
Along
This one
with
got to like
metals here
22.
in general. I'm going to show you our
week ago.
futures board, and it's not just gold. And in fact, we
one's
had
still
several
getting hit.
metals that outperformed gold.
Rocket Lab, the
commodity
call is
heat
at
map.
5. I think
We're
the
not
actual
gonna talk about
earnings
orange
should be at
juice.
like
That's in the pole
now,
position there,
4:15. You keep getting
5.7%.
those numbers
But check out silver up
any second now.
4.75%. Then you can go to see platinum up 3.
Big Bears up
Copper
3. Don't have their numbers yet.
2.93.
Rocket Lab again. We should get a
Palladium up
reaction very
2.87,
soon.
and then you have gold. But I'm going to
And Clean
concentrate
Spark,
on
the
gold
billion
here
dollar
for a
offering,
hot
that's why that
second.
stock's
Let
down.
me
Plug
just
did
show
a
you
beat
the
on the top and the
year-to-date.
bottom.
We did
Plug
have
is up
kind of a
6.3%.
nasty sell-off recently. This was 10%, and so that's not nothing. Investors definitely felt that.
Oh, I didn't do a
You can
Rocket
see
Lab
it's
pump or
still
dump.
holding on to gains of about
so everyone said pump on
55%.
CoreWeave. You're
And I
gonna get a
had the
flat
opportunity
reaction.
to sit down today with
Rocket Lab
Peter
is not next
Borish,
Tuesday, it
for
is
Stocks
today.
in Translation. For those of you
Rocket
who
Lab
are not
pump or
familiar
dump.
with him, he used to work with
Still don't have
Tudor
Big Bear
Jones
numbers,
back
but
in
let me
the
just
day,
look at
was a
it.
founder when Tudor Jones began one of his hedge funds. And
Big
so
Bear.
this is kind of a big call here.
Nope,
I just
not on the
want you to
website.
listen what
I don't know
Peter
what the
has to
street's
say
reacting
about
to.
gold.
Not on the website.
A stronger
Wait,
dollar
is this the website? No. Do we got it?
higher
Yes, I got
interest
it.
rates, which is not good for gold.
Okay, I think I have it.
A stronger dollar
I
potentially
think I have it.
indicates that the stimulus effect that we were talking about before related to the legislation that was passed by Congress.
So, all right.
is
So,
going to have
let me
a
know if
bigger
you see a
effect. We
Rocket
talked
Lab
about
move.
that accelerated
Let me get into
appreciation,
Big Bear.
et cetera. So
Don't have the
those
Rocket Lab
things
stuff yet.
themselves
All right, Big
are
Bear.
not
There's a lot of stuff to
particularly
read. However,
bullish for gold,
revenue's down 20% year over year to 33 million.
So right now, you be on the
Gross
side.
margin was
Make new highs, you can
22%.
go
That's
with it,
down
which
3%
isn't that
from
far away. You take out
25.9.
last week's
Net
low,
income was
it's a good sign.
2.5 million
It
compared to a
was
net
a
loss last
wide-ranging
year. So they are
conversation.
profitable.
As you heard him, he was
Non-GAAP
worried
adjusted
about
EBITDA of negative
longer-term
9.4
interest rates
compared to
shooting up.
positive
And if that is the
900,000
case,
last
then
year.
that kind of
Down
hurts the gold
year-over-year
position.
adjusted EBITDA.
Bottom line for
And then
Peter, if it
SG&A of
takes out last
25.3,
week's
that's up 8
low,
million year-over-year.
then it's a sale. But
Backlog
nevertheless,
is
we had a huge
376.
update, so it's going to take a little bit of
So
work
the
by
company
short
is
team to
growing
get
negative
back to that point.
20% with
Want to move on to
negative
my third
or
point,
with
and if you
declining
keep track
margins,
of
not
these,
negative
it's
margins,
probably
but
going to be
declining
about
margins.
crypto. And yes, it is indeed about
And negative
Bitcoin,
non-GAAP
which has
adjusted.
reclaimed the 106,000
We'll go back into the numbers,
levels.
but
Now, while I was out over the last
I don't know
week
if
and
that's
a half,
a
I
beat
saw
or a miss.
some headlines where
Notifications, but
Bitcoin
those are
dipped
the
below 100,000.
results
And
from
let
their
me just
website
bring
for
up a
Big Bear.
3-month
Big Bear now
chart
is
so we can
down
kind of get our
1.2. It was
bearings.
just up 3,
Because
just
when we
went
got
red.
this high
Rocket
here,
Lab, we
this
got to
was a
move
takeout
2%.
high. We came
That's a
down
candle.
to
The
the
candle
ideal
is
short
green.
level. Shorts were in control right before
2.9. Okay, we
100,000,
should be
but
seeing
we are
more
now trying to
soon.
make our way back up. Shorts are still in control, so I am a short-term bear in Bitcoin, but I am
Rocket
still a
Lab.
long-term bull.
Oh, we got a double beat.
Right,
Wow, Rocket
We're turning out
Lab.
a CoreWeave as that company
Oh
just
my
reports third
goodness.
quarter results. Let's take a quick look
They
at those
beat
numbers.
EPS by 70%. Street thought they would lose 10 cents a share. They only lost 3 cents.
The estimate was a loss per share of
I think they're
57
getting ready for
cents.
profitability.
Adjusted operating
I think
income,
Rocket Lab is getting ready for GAAP
217.2 million.
profitability.
The street was
They're in
closer
your
to
future revenue. They beat by 2%.
177.2
151
million. Just looking for
was
the
what the
top
street
line
expected.
here.
They came
There
in
it
at
is, Q3
155. Revenue's up
revenue,
48% year over year.
Consensus
EPS is up
was at
70% year over year.
1.29
My
billion.
goodness.
For
You're
adjusted
getting a
EBITDA margins in the
well-deserved
quarter, those
5%
clock
move.
in
Now,
at
Rocket Lab did hit
61%.
70.
Consensus
month
was
ago,
close to
so
62.3%.
I know we're not at those levels,
Just
but
looking at
definitely
the
deserves
initial
a
reaction
positive
here
earnings
in the
reaction. Right,
after
up
hours.
6.
We're not doing a whole much, down about 0.8%. The stock action in this one has been interesting because it was up big heading into the print since the IPO in March, but it was down about 25% since reporting last time. That was in mid-August. Obviously, we've seen these new questions raised about the AI trade, about AI valuations. On the other hand, CoreWeave bulls like this setup into the print because they argued this was a more attractive risk reward. They had pointed to what they saw as really more positive data points from the cloud giants. In other words, big tech continuing to raise guidance for AI CapEx, and they argued that was good news for CoreWeave in the quarters ahead. It'll be interesting, of course, all eyes on a conference call, see what executives say about the quarter, the print, and what's ahead. The street fairly divided on this one. 14 buys, 12 holds, and 3 sells. Well, meanwhile, Paramount Skydance is out with its third quarter results, providing an outlook for 2026. Here to discuss is Ken Leon, CFRA, Director of Equity Research. Ken, let's get your take on those results. What do you make initially of the print here?
Well, the print is they're a little bit short on revenues. The street was looking for about 6.9 billion. You can see it was 6.7 billion. Clearly, the third quarter is important because we want to see improvement in the areas that need to turn around, such as streaming, the traditional incumbent businesses, TV. We'll have to see what those results are, and film. Film is always event-driven on the releases that they have each quarter. There wasn't anything monolithic, like Mission Impossible.
Let me ask you, Ken, turning to Warner Brothers Discovery, they plan to make an announcement on their future by Christmas, per reports, Ken. WBD has rejected 3 offers from Paramount for a full takeover. CNBC says the last one was for $23.50 a share. What does happen with Paramount and WBD, Ken? How do you think this all plays out?
Well, of course, Paramount does have interests and perhaps has made bids. It becomes a little problematic in terms of funding, whether Paramount has available capital to make this kind of deal. Even
This is not an interesting company at all. I'm not going to waste your time looking at Paramount's review.
Could talk about high 2% growth in the GDP from a U.S. Economic perspective. So again, more risks from the labor market in the near term, but I think you got to start thinking about how does the AI story broaden. There's a lot of good news priced into the tech stocks, and I understand the interest and the momentum and the excitement, but if AI is as transformational as we think it is, you're going to start to see those profit opportunities expand beyond the tech sector.
Kevin, what are the catalysts in the absence of government data and maybe besides the prospect of the shutdown, Andy?
Yeah, one area that I think we should look to at this point in time, and everyone's overlooking it right now, and perhaps rightly so, is the healthcare sector, John, the second best performing sector of October. And there is an AI play to healthcare as well. Think about the partnership that was announced last week between Eli Lilly and NVIDIA to actually build supercomputers to assist with drug discovery and drug development, AI use for group. I think that's fascinating. And then you look at the M&A opportunities that exist within healthcare for small cap biotech. I wouldn't be surprised if Eli Lilly didn't become more acquisitive. And then you hit announcements today from a small cap company like Cogent Biosciences, a small.
So we're going to try to listen to earning call once CoreWeave does theirs. It doesn't look like it started. It starts at 5. We're going to be listening to it, but until then, let's just look at the numbers and what they reported. So CoreWeave reported a quarter loss of 0.0 cents per share, which beat the analyst expectations of, by 78%. So those are not bad numbers at all. So let me go here so we can just do a visualized review. So here is the analyst expectations, loss of 0.52. This is what they were expecting them to lose, but then they ended up losing actually a 0.08 cents, which is phenomenal because they're losing less money at the bottom. Revenue they beat as well, 1.30, so 1.036 billion. They also beat that by about 6%. It's pretty impressive because if you look at Q1 of 2025, EPS was almost 400%. Revenue they beat, and then EPS Q2 of 2025, they started beating EPS, they started beating revenues, and seems to be on a good trajectory. And it's only been one quarter with, the numbers didn't look good at all from revenue and EPS perspective. But blue is the actual, and then the gray is obviously expectations. They consistently beat revenue numbers historically. And look, after hours, the market isn't too happy with them, which I'm kind of surprised about because they reported really good numbers. They lost less money, they brought in more revenue. It looks like the market is not happy with them. They're down 1.7% after hours. CRWV Oh no, CRWV, CoreWeave. Yeah, the market is not happy with them after reporting amazing numbers. So I don't understand what's going on here. CoreWeave beats third quarter revenue estimates. I mean, they are at the center of like AI in the whole industry. So, CoreWeave reported revenue 1.3 billion for third quarter compared to which analyst average of 1.2 billion. Yeah, I don't know why the market is really unhappy with them. They reported really good numbers. And once again, this is still a small company when you compare it to like what's going on in the AI segment, and a lot of people are saying, "Oh, well, we're in an AI bubble," and I kind of say like, "What are you talking about? We're in an AI bubble. We just got started. We have some of the largest institutions just getting into the business. How are we already in a bubble? Like almost 3 years later, but then the pace of AI is actually picking up even more and more now." Let me bring this a little closer so you can hear me. So I don't understand why people are saying it's a bubble. If anything, it's just the start. And when everybody's saying it's a bubble, it's probably it's time when it's actually not a bubble at all, and the stock is gonna start taking the market is gonna pick up even more, because anybody that thinks the we're in an AI bubble is gonna leave the market, and it's only new investors that are gonna come in and keep driving demand in the industry. It's not like we're having a huge sell-off, and there's still like large partnerships and still a lot of margins to take away from the largest leaders. Like Nvidia has a large lead, and they can almost charge as much as they want for their AI products, Nvidia chips. But then you have a company like AMD, who was rewarded greatly today, and they have their analyst day tomorrow, by the way. I'm going to be watching that. They have that at 1 o'clock. But Nvidia still has a huge margin to eat away from AMD still has a large margin to eat away from Nvidia. So you have a company like this that still is small and is still becoming efficient and providing the type of chips that they need, specifically in the inference type of training. I think there's still a whole bunch of room to go, especially from a demand perspective. The technology for AI is actually just being built out, because yes, used to be GPUs used to be the best way to go. Nvidia had Nvidia had a really good the really good technology for it, but we still got so many other companies that are entering the segment, creating chips that are very useful for these kind of companies like AMD. AMD is focusing on the chiplet architecture, which is way more, one, less expensive, more efficient, and more output per token. So it doesn't cost as much, takes less electricity, and you get more output. So all these are benefits. So as we continue to progress, like in the era of AI, there's going to be more and more companies that are going to be the Google of the .com era. So who's going to be the Amazon, the Google, the Facebook of the .com era? And those companies are being developed right now. Maybe that's CoreWeave. I don't know, but there's a lot of new companies that are really just coming up right now in this era, and maybe CoreWeave is one of them. But the report, I mean, CoreWeave reported numbers. These numbers are getting better and better every quarter. So that's why I like a company like CoreWeave's. I like a company like AMD, because they are at the beginning of the AI sector. Let's see what we got going on here. I did not want to. Yahoo Finance still doing some ads. CNBC, hopefully they're talking about something interesting. Schwab, what's going on in Schwab? They're talking about Oklo. That is I was gonna say short. I don't short stocks, but geez, Oklo.
from a lot of these Fed speakers. And so I think this is really going to be something that we continue to see as we wait for this data vacuum and for the official data to really hit the wire. And the next up will actually be Michael Barr, and he'll be speaking at a fintech festival over in Singapore overnight. And so no doubt we'll be weighing in on the whole AI innovation and valuation story, as we've heard many officials putting their 2 cents worth in lately, Marley.
Yes, certainly. I was just updating to see if we've had any progress in this government shutdown, but no vote just yet. So we'll, of course, have more on that tomorrow. But that's going to do it for us today on Market on Close. For Sam Vadas, I'm Marley Caden. Be sure to download the Schwab Network app, available in the Apple App Store, and tune in 24/7 on schwabnetwork.com. Market Overtime is coming up next. I hope you have a great rest of your Monday.
Welcome to Market Overtime. I'm Sam Vadas. Our next guest is an MIT graduate, an Air Force Reserve member, and an inventor with close to 50 patents under his name. All impressive titles, but you probably know him as the pioneer in Bitcoin. I'm very pleased to introduce now Michael Saylor, Executive Chairman of Strategy. Welcome to Market Overtime here on the Schwab Network.
Thank you for hosting me.
First and foremost, congratulations on becoming the first Bitcoin treasury company to be rated by S&P. How does it feel, and what does it mean?
Well, I think it's a very legitimizing step. It's auspicious for the industry. This year, we launched 4 digital credit instruments, Strike, Strife, Stride, and Stretch. They were all IPOs. They all publicly trade. Those are backed by Bitcoin. And they've been very successful, but they've been unrated. And so many fixed income investors and insurance companies and large pools of capital, they would like to buy them because they have superior yields. They're really cool instruments, but they can't without a rating. And so part of the maturation of the entire asset class is getting the traditional credit rating agencies to begin to acknowledge digital credit. And this was the first credit rating of a Bitcoin treasury company ever in the industry. And we've been at it for 5 years, so I think it's a big milestone.
It certainly is a significant step, and I just want to sort of talk about what you do, because you mentioned some of your product offerings, and we will dig into that in just a little while. But what is the best way to understand what you do and how?
Well, it all starts with Bitcoin, a digital commodity. Bitcoin is digital gold. It turns out that it's also a global asset. It trades.
I don't know, Michael Saylor. Boring. He sounds so excited. We're not going to watch Michael Saylor. CoreWeave. Let's listen to this.
Exposed if they're in that name.
Yes. Oh, over time. Like you were saying, John, CoreWeave, a portion of their business model is basically providing swing capacity to hyperscalers. To the extent that Microsoft, for example, can't bring on as much capacity as it would like in a short period of time, they may lean on someone like CoreWeave to help out. I think, over a given period of time, remember that CoreWeave's contracts with these players tend to be multi-year in nature. You might sign a 4, 5, 6-year contract. So, if AI demand were to pull back some, the contracted revenue that CoreWeave has would presumably not be affected. But to the extent that this is a growth stock where people are expecting continued growth in their backlog, that would obviously have meaningful implications for the multiple.
I want to see a revenue backlog that has almost doubled. Obviously, at least in the near term here, there's a huge amount of demand that's outstripping capacity. So how meaningful is it that this Core Scientific deal has fallen apart, since that would have brought more infrastructure online more quickly?
Yeah, great question. So I think what Core Scientific really would have done for CoreWeave is give them access to more capacity faster. So remember, Core Scientific was a crypto miner that was basically repurposing a lot of its power capacity to support high-performance computing workloads, so basically building data centers. CoreWeave was its first, and at least to date, only customer along those lines. And I think Core Scientific was probably holding back some of its capacity, some of its pipeline, to try to diversify its business across other users. If CoreWeave had been able to acquire Core Scientific, it would have been able to grab that pipeline for itself and maybe accelerate its growth. I think without Core Scientific, the company will need to lead on, other partners, other channels to really try to fill that pipeline, like the deals that it's done with other crypto miners or one that it recently announced with Poolside as good examples.
Okay, a lot of core analysis here. With shares of CoreWeave down about 1.5%. Nick Del Deo, thanks for joining us. Paramount Skydance earnings are out as well. Julia Borson has those numbers. Hi, Julia.
Hey, Morgan. This is the first earnings in the combined company from the combined company Paramount Skydance. The company reporting an aggregate of $6.7 billion in netted revenues for the entire quarter and an aggregate adjusted loss of 12 cents per share. That's for the Paramount Global company pre-merger as well as the period in which the companies were combined. TV revenue a little bit lighter than expected, but direct-to-consumer revenue coming in stronger than expected. The company also guiding for 2026 for total revenue of $30 billion, saying that'll be led by a healthy acceleration in D2C revenue with global profitability. Company also announcing that they've increased their run rate efficiency target from $2 billion to at least $3 billion, saying about 2/3 of that is attributed to non-labor, and most of their labor efficiencies, otherwise known as layoffs, have already been realized. And they also say they expect adjusted EBITDA of $3.5 billion in 2026, saying that'll be driven by progress against their increased efficiencies plans, as well as investments they're making in the business across content and strategy. It's been just about 3 months since this deal went through, and David Ellison has been very busy. I'm sure we'll hear more about that in the call. Back over to you, Morgan.
All right, Julia Borson, thank you. With those shares up about 2.5% right now. Well, President Trump's thinking the health insurance stocks today with some strongly worded social media posts. We're going to have the full story coming up.
And the president also has a plan to make homes more affordable and therefore more accessible. His plan, a 50-year mortgage. Could it really happen? We'll explain next on Overtime.
50-year mortgage. Dumbest thing I've ever heard. Like, why am I going to get a mortgage that is 50-year mortgage? Like, that's stupid. Like, I'm going to pay this off till I die? Like, who am I going to pass off a 50-year mortgage to? Like, I'm going to pass it off to my kids, and who are they going to pass? They're going to pass it off to their kids, and then it's finally paid. I think that is pretty ridiculous. It's a dumb strategy for Trump to go with, just because it doesn't make sense at all. There's a lot of different ways they can incentivize the market, but I think going with a 50-year mortgage is not the way to do it, because at the end of the day, if you get a 50-year mortgage, you're just literally renting the house from a bank. And if anything, it makes the down payment down like maybe 10% cheaper. Your monthly payment 10% cheaper. So it's not even like a significant benefit to you. It's just like anything that you barely notice, or it would even impact your financials. So that's how I wouldn't, like, it doesn't even make sense. Like, a 50-year mortgage does not make sense. I think if this is what they need to do, what they need to do is allow like the home manufacturing a lot faster, loosen the criteria around this, and then also maybe make the down payment less, and then remove all the iBuyers, the large institutional companies that go out there and buy out homes, individual homes that a couple could buy. So they need to limit large institutional buys. REITs should not be allowed to buy homes, because why is this REIT buying all these apartments, and then you have all these people in the United States that can't even afford a house? So these are some things I think the government can work on, and not come up with like a 50-year mortgage. Politicians can't deal with defense this is actually kind of dumb. I don't want to look at that. Landing the CEO of Sustainable Development. Let's see what this is.
Type of real estate that we want, where a helipad could go.
Well, how do you envision the customers of these vehicles using them? Because if I think of high demand routes, they're not necessarily from.
Weekdays, CNBC.
So just think about the success that off-the-shelf drones have had against the most advanced weapon systems. And so we're at a moment of sort of dislocation, a moment when there needs to be a new investment cycle and a new round of technology innovation. So Palantir is obviously a great example of that. There are lots of others. But the set of capabilities that you needed for yesterday's environment are very different than what's needed today. So if you look at the Trump administration, they're investing very heavily in autonomous systems, in AI, the Golden Dome, missile defense. There are many other examples of that, and those are areas that don't lend themselves to like immediate payback. These are going to be investments that will be sort of afoot for 5, 10, 15 years or longer. Those are the types of things that we're investing in.
When you hear or when you see Russia test a delivery mechanism for a nuclear weapon, President Trump then says, I believe it was he reiterated this on 60 Minutes, that the U.S. will begin testing nuclear weapons. Where does your brain go as an investor?
So those are obviously scary themes to talk about. I'd say broadly, it just reflects the fact that we are back in an environment where the U.S. has real geopolitical peers. We are back in a Cold War environment, and there's a mindset shift that needs to sort of follow from that. And a set of investments that need to follow it. So if you look specifically at the areas where our peers have been investing heavily, hypersonic weapons is one of them. And one of the big reasons that you have the Trump administration so focused on the Golden Dome missile defense system is that our current missile defense systems, cannot stop. They were designed for a different era of ICBMs. They're not designed to counter hypersonic missiles. You have innovations in, I think the specific example that Trump was responding to were nuclear-powered cruise missiles, just continued example of the innovation that I described earlier. And so, the current battle that we have with our peers is really an innovation battle. You can see that most acutely with, semiconductors and all the tension around Taiwan and tariffs and so forth. But you can see it in lots of other areas as well.
Is it hard, and I'm not going to phrase this right, I'll do my best, but is it hard to invest in a potential nuclear war outbreak? Sure, there might be money-making potential there, but this is, to your point, this is serious stuff.
So we're not investing in weapons. We're not investing in nuclear weapons.
Okay. I just wanted to make sure it's.
No, of course, of course. So here's how I think about it. President Reagan had this concept of peace through strength, and that concept has really carried over in the thinking of the U.S. for a couple of generations now. That is sort of the critical thing that we're thinking about, which is where you have real geopolitical risk is when there's an asymmetry in capabilities. So, for example, Russia was not deterred by Ukraine, and you could see sort of where we are now. What's important is that if you have parity of capabilities, which is the primary source of deterrence, that's what prevents major wars from happening. And the U.S. is in a mode now, and NATO countries are early in that cycle as well, of investing in a next generation of deterrence. So to be clear, we're not predicting nuclear war, we're not predicting World War III, but I do think we're in an environment where we need to be very clear-eyed about the fact that our peers have been investing in a new set of capabilities that are threatening, and that requires a new investment cycle on the part of the Western Alliance to counter those capabilities and match them.
All right, hang with us, Brooke. We're going to go off for a very short break. We'll be right back on Opening Bid Unfiltered.
Something that's pretty impressive for Rocket Lab is that this is a company that their average monthly target price by analysts consistently goes up and up and up. It just never stops. And usually when something like this happens, it's it's a company that is performing well. They're taking market share because right now their biggest competition is Elon Musk's SpaceX, and I remember there is a point on X where Elon was kind of saying, well, like we're not going to we're gonna stop launching rockets to space, and we're gonna stop the advancement of space technology, and they literally threatening the American government, saying we're not gonna launch anything, and we're gonna decommission them, which I thought was just very, very ridiculous, because it's really ridiculous, because you can't do that. You can't do something like that. When you do that, what you will do is you will breed a whole bunch of innovative individuals that want to make that money that you don't really care about, and they want those partnerships with the government. So this is why I think sometimes it's when Elon can really mess up his own company when he's playing these types of games. Let's see where CoreWeave. Let's see what is being said on X about CoreWeave. They did reporting. Yep. Sales 1.4. Q3 earnings. Yep, revenue up 134% year over year. Revenue backlog $55.6 billion in revenue backlog, which is so impressive. Capital expenditures 1.9 billion, and then adjusted EBITDA up 61%. Adjusted operating income 217 million. Adjusted net income a loss of 41 million, which is about a 3% margin. Those are not bad numbers. CoreWeave Q3 earnings are out with a 2x beat. Yep, they did beat 2x. Pretty good numbers there. We're gonna try to listen to the earnings when they come out. Let's listen to what Jensen Huang said about the company.
We're always looking for great startups to invest in. One of my favorite ones was CoreWeave.
Right.
My only regret is I didn't invest
Add that to the list.
enough. Yeah. And so in all of these investments that we've made recently, we've made some really terrific investments, and largely my only regret is that we didn't invest more, because these are really special companies, and they're part of our ecosystem, building out the AI infrastructure for the world. We're always looking for great startups to invest in.
Even though he's very hyped about the company, CoreWeave does buy their product. I mean, they do have a really, really tight relationship with CoreWeave. CoreWeave uses their products and buys the data centers, building out the data center, buying NVIDIA's products. So that relationship is there. So obviously he's going to say good things about the company and for the success of the company. Then is right here, 1 hour ago, Wales buying 2 million CoreWeave, 125 call for the 28th of the month. Let's see if there's actually a call. CoreWeave earnings call. Hopefully there is a live call going on. I do want to see that. This is Q2. Yeah, this is Q2. We want to see Q3 earning call. Rocket Lab. All right, I think we're going to just listen to this here. Let's listen to this. What
we are now in the process. We're in final bids of getting the finest system anywhere in the world. I've analyzed it. Sean Duffy has been working really hard on it, doing a fantastic job, by the way. And over the next 2 or 3 weeks, we'll be handing out the finest air traffic control system anywhere in the world. All the towers will be equipped. They were going copper wire into glass wire into other types of wire. And if you knew anything, you know copper wire doesn't work with glass. You know glass doesn't work with other substances. And They spent billions of dollars, and when they turned it on, nothing happened. Okay, we're getting the most sophisticated, all brand new. Every control tower will have the same exact system. It'll be the most sophisticated system by far in the world. And what we've done is we've looked around other countries, and we've taken the absolute best systems in every different form, because there are different. You have lots of different companies like IBM and Raytheon and a lot of great companies. They're all bidding, and we're going to pick the best one, and it'll get built relatively quickly, and we are going to have the greatest air traffic control system anywhere in the world. Thank you very much, everyone.
I really do think 2026 is going to be a question about affordability. He gets a question about affordability, immediately pivots to he solved 9 wars, big, beautiful bill. All of those are legitimate arguments, and all of those are legit talking points that the Trump administration should be holding on to. But at its core, he's not answering that question, right, about grocery prices, because he knows at the end of the day, grocery prices are up. I mean, this is just subjective. If you look at the data, there are some things that have come down, but the majority of stuff is up. Now, it's not up like crazy, but it is up, and it's having an issue on affordability. I really wonder, and I think the reason this whole $2,000 dividend thing is becoming mainstream from a talking point perspective on Trump, I wonder how the party is going to navigate this issue. Because there's a lot of ways to respond to it. As Tess says right there, affordability is up across the world. Yeah, dude, I don't even think this argument is real. Like, affordability has always been an issue. You're telling me in the past 9 months, things have become so unaffordable that every single person just simply, like in certain parts of the country, 100%. In New York, obviously, we've seen that. But you're telling me it's that much different from this time in 2024? Like, if that's the case, the most important argument during the Biden administration versus Trump would have been affordability. It wasn't. It was illegal immigration. It was not the cost of living. I think this is why we spent some time analyzing this Mamdani thing. The Mamdani election, I think, really created a headline argument around affordability that now every, I guess, Democratic talking point is hitching onto. And as a result, that could force the Republicans to kind of make an argument around how to defend that the administration is affordable. Which, look, they've done a bunch of things that can contribute to affordability with tax cuts and no tax on tips, no tax on overtime, et cetera, et cetera. But that core argument about, hey, grocery prices are down, et cetera, that's one thing that I think, when MTG starts to go the opposite direction, you could tell it pissed him off. I mean, as soon as he heard her name, he was not happy to have to deal with that question. By the way, this was the tweet by Kaz. Dude, I don't get this. I'm sorry. I hope Open Door goes to the moon for everybody, but really? Like, if Vlad tweeted, hey, guys, my family's going to be buying some Robinhood stock tomorrow, you would not see me defending that, bro. Like, Tanner, Roy, and I would not be defending that. Like, what is this? Tomorrow's the first day I'm allowed to buy Open and my family is buying $1 million. Really going to put an exact number of how much your family is buying and letting the public markets know as a CEO of the company? I mean, like, he's not going to get investigated because this is the Paul Atkins is very laissez-faire and he's not going to go crazy about this. But is Open Door even up after hours? Because it's just weird, right? It's not just me, right? That's any CEO who were to say that. Open Door is up 2% after hours. Of course it is. Why wouldn't it be? It's up 21% of the day, 2%. I mean, if he's telling you his family's going to bid it up, people are like, okay, cool. I'm going to buy some more. No, I understand if it's not in a blackout period, he's fine. Like, technically, he can get away with saying this. It's just weird, bro. The way he's saying it. Tanner says, but are they buying it on Hood? I mean, probably they are. But goodness, dude. I don't know. That's just weird. To be that specific and give a dollar amount and all that stuff. I don't know. He's not going to have a legal issue with that. It's just, I don't know. I guess that's how he's embracing social media, and that's how he's going to do it. So there you go. But again, yeah, going to Trump. I mean, what are people thinking? We got 8 minutes until the CoreWeave call. Are people thinking that his response was good? It wasn't good. I don't even think it has to be a political analysis right here. It's just objectively, if you ask someone a question about grocery prices, affordability, and then the conversation goes to Russia, Ukraine, you can tell they're trying to obfuscate it because they don't have the best answer to the question. Which, look, in 1 year, the guy's not going to get the country to be affordable. So I don't even think it's something that you can easily blame Trump for. It's like the economy is not affordable. It's like, okay, we got a lot of different issues. I don't know if you put all the affordability blame on him. But objectively, he dodged the question. And so did Mike Johnson the other day. So it's one of those things where the market's going to have to figure out how much they care about this stuff. Bad response. He just made unrealistic promises when he campaigned. The thing that's confusing me is, dude, affordability was not the concern of the campaign. For anyone who covered the 2024 election, it was about DEI, quite frankly. That was a big issue. The sort of woke social stuff, right? Men and women's sports, all that was like a major thing. And then immigration. Like this affordability, I remember covering that campaign. That was not the number one. That was not Biden's or Harris's talking point. It really was. So it's this thing like came out of nowhere. And now it's like the de facto conversation around this. And I guess we're gonna have to see what happens. This is because of the impact of the tariffs. Well, I think that's why Trump also made a lot of arguments today about why the tariffs are actually positive. Look, the Supreme Court thing goes the wrong way. I don't know exactly what they're going to be able to do, but I think Trump is trying to gear up to get people to realize that, the tariffs are still very positive. Tess says, England's been in a cost of living crisis since COVID. I always thought when I'm on your side of the pond, you hadn't been affected by it yet. I'm not saying the cost of living hasn't gone up. I mean, obviously over the past 5 years, it's been dramatic, and, we had record levels of inflation, and that also caused the cost of living to go higher, contributed by Republicans and Democrats. It's almost like ASTS flat after hours. It's almost like it became a talking point after this Mamdani thing. And now every time you hear this back and forth, it comes down to affordability. And I'm like, affordability was not a word that people talked about in 2024 during this election. So, but this is politics, right? Politics pivot super quickly and people latch onto an idea and a topic. And now I think that's going to be the major concern. Rocket Lab, we are not listening to it. Matt Money is listening to it. I'll put the link to his channel for those that are curious about that. Big Bear, let me see if they're taking questions. Big Bear's still up 12%. Rocket Lab's up 8.4%. Let's see if Big Bear is still doing their earnings. And then we got CoreWeave in about 5 minutes.
House Speaker Mike Johnson is going to need as many Republicans as possible. He likely can only afford to lose 2 to ultimately advance the legislation.
What about the Democrats, Tyler? I am curious about some of the reaction that we've seen amongst House Democrats to this potential deal that Senate Democrats appear to have agreed to, and some of the backlash, the idea that maybe they didn't think that the Senate leaders held the line or fought hard enough to include some of those ACA provisions.
Right, exactly. Many Democrats are upset, including those that we've spoken to on balance of power, who say that this promise that there's going to be a vote once the government reopens on extending the Affordable Care Act premium subsidies just isn't enough. But those 8 Democrats in the Senate, the moderate Democrats that got on board with this plan, said that after 40 days of negotiations, this really was the best they can do. I'll also point out that these 8 Democrats, importantly, all aren't up for re-election, and perhaps that gives us a little bit more insight into the strategy that they had going into this. But it's going to be a keen issue. We did hear from House Democratic Leader Hakeem Jeffries earlier today lend his support to Senate Minority Leader Chuck Schumer. So for now, they appear to be on the same track.
Tyler Kendall down in D.C. here as we wrap up the close, a push ahead to what the markets will have their eye on. Of course, they will be focused, Katie Greifeld, on what goes on in Washington. But just a reminder, tomorrow is Veterans Day in the U.S. Observances means that the U.S. stock market is open, but the bond markets will be closed.
Yeah, one of those funky days. We also, at 6 a.m. Eastern, get NFIB small business optimism, going to be an important check, of course, on how the lifeblood of the economy is feeling right now.
And we're also going to get some Fed speak, including out of bar and more earnings as well, including from Oklo, of course, which has sort of been a big darling in the market over the past few months.
Absolutely. But that does it for the close.
Thank God, Katie. I haven't slept in 72 hours.
There you go. This is the close. Have a good evening.
Years. But that is what we've got right there. CoreWeave, we got 3 minutes until this call starts. And then we'll keep going. Big Bear AI, again, call is closed. What did we have on the poll? Rocket Lab, 69% of you said pump, 31% said dump. Rocket Lab definitely got a pump. Hopefully the pump continues in the call. And overall, I'm very happy as a Rocket Lab shareholder with that quarter. That was not a bad quarter by any sense of the imagination. ASTS being flat, I think, is also a win. ASTS, again, has doubled in the past month and a half. So, yeah, it's not back at 100, but you can't be too upset about it. Rocket Lab right there up 8%. Beyond Meat did not come out yet, guys. And by the way, the earnings is, if you go to their website, it says the earnings is November 10th. So for everyone saying it's tomorrow, their website says it's today. But I don't see the results anywhere, not on Twitter, not on their website. I mean, I guess some people are thinking 5 p.m., so maybe in 2 minutes we'll get the results, but so far has not been out yet. Japan considers using public funds for nuclear projects. Interesting. Okay. I mean, you might start having some nation states tap into their country balance sheets to fund new initiatives. I mean, if that is nuclear growth led because of data centers and like energy related to data centers, that would be quite interesting. The United States has not officially done that outside of the equity stakes that we've taken in some of these companies. Open Arrow right there up 2% after hours, and then Nebius up 2% as well. Did TeraWulf go positive? Wow, TeraWulf went green. Even after a 900% EPS miss, down 4%. Now it's back to green. CleanSpark slowed down 3% after the $1 billion offering. Rumble is down 1%. Iren's up a little bit after hours. Big Bear still up 12.9%. And then CoreWeave is down 1.3%. Amit, would you eat Beyond Meat medium rare? That's a good question. The funny thing about Beyond Meat is you got a lot of people that own the stock that are never going to eat their product, but they're obviously buying it for the movement. But yeah, I don't think most people in the name would ever eat the product. I don't think I would. Okay. Do we have it? Are we live on CoreWeave? Not yet. We got about 30 seconds and then we should be live. TeraWulf did $5.2 billion in offerings. Their market cap is only $5.8 billion. Look, a lot of these plays are going to have to raise capital. If that capital is accretive, it'll be because they get a lot more hyperscaler deals. If not, it might not be the best use of tapping the debt markets. But you do have more people. Okay, CoreWeave's live. I'll be Beyond earnings in a second, because that should be popping up. I'll put that in the chat. But I think CoreWeave is live.
...2025 earnings call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. To ask a question, press star 1 on your telephone keypad. To withdraw your question, press star 1 again. Thank you. It is now my pleasure to turn the call over to CoreWeave.
Thank you. Good afternoon and welcome to CoreWeave's third quarter 2025 earnings conference call. Joining me today to discuss our results are Mike Intrator, CEO, and Nitin Agrawal, CFO. Before we get started, I would like to take this opportunity to remind you that our remarks today will include forward-looking statements.
It definitely sounds like AI. It definitely sounds like that's some AI.
Differ materially are set forth in today's earnings press release and in our quarterly report on Form 10-Q to be filed with the SEC. Any forward-looking statements that we make on this call are based on assumptions as of today, and we undertake no obligation to update these statements as a result of new information or future events. During this call, we will present both GAAP and certain non-GAAP financial measures. A reconciliation of GAAP to non-GAAP measures is included in today's earnings press release. The earnings press release and an accompanying investor presentation are available on our website at investors.coreweave.com. A replay of this call will also be available on our investor relations website. And now, I'd like to turn the call over to Mike.
Good afternoon, everyone, and thank you for joining us. CoreWeave once again delivered an exceptional quarter, showcasing the accelerating momentum underlying our business as AI adoption proliferates globally across industries. We continue to operate in a highly supply-constrained environment, where the demand for CoreWeave best-in-class AI cloud platform far exceeds available capacity. This insatiable customer demand is a clear signal that the world's leading companies trust CoreWeave to power their most critical AI workloads. In Q3, we beat expectations, delivering revenue of $1.4 billion, up 134% year over year. We added over $25 billion in revenue backlog in the third quarter alone, bringing us to over $55 billion in revenue backlog to end Q3, almost double Q2 and approaching 4 times year to date. Further, CoreWeave has reached $50 billion in RPO faster than any cloud in history. These results demonstrate the deep confidence customers have in CoreWeave, the company they trust as their essential cloud for artificial intelligence. We continue to scale aggressively, even as the industry remains capacity constrained. We expanded our active power footprint by 120 megawatts sequentially to approximately 590 megawatts, while growing our contracted power capacity over 600 megawatts to 2.9 gigawatts. This leaves us well positioned for future growth with more than 1 gigawatt of contracted capacity available to be sold to customers that we expect to largely come online within the next 12 to 24 months. In Q3, we executed large-scale compute contracts with many of our largest customers, including Meta and OpenAI. Each represents a meaningful expansion of existing relationships and a diversification away from any single customer. We also grew our relationship with a leading hyperscaler, marking the 6th contract with this customer to date. In fact, 9 of our 10 largest customers have now executed multiple agreements with us, the only exception being a new customer we onboarded in Q3. CoreWeave is the force multiplier that empowers pioneers to accelerate breakthroughs in AI innovation. These are the world's most sophisticated AI organizations, and once they experience the performance, flexibility, and reliability of CoreWeave Cloud, they consistently expand with us. That is the strongest validation we could ask for. Our exceptional growth illustrates just how quickly AI adoption is progressing beyond the frontier AI labs and hyperscalers. Broader global demand and our recent large wins are driving diversification of our revenue base. For example, the number of customers that exceeded $100 million of revenue over the last 12 months tripled year over year. AI native and enterprises across sectors are embracing CoreWeave to transform operations and unlock new sources of innovation, productivity, and growth. At the forefront of foundation model development, Poolside selected CoreWeave to power its mission to build artificial general intelligence and enable the deployment of agents across enterprises, while Periodic Labs is using CoreWeave to push the boundaries of scientific discovery and computational research. At the application layer, we added AI native customers like Jasper, who chose CoreWeave as their cloud partner as they transform the digital marketing landscape. We are also seeing incredible momentum within enterprises. CrowdStrike chose CoreWeave to advance the development of AI agents for cybersecurity, while Rakuten is using our platform to transform their visual language models, helping to achieve greater transparency, reproducibility, and speed in their AI workloads. We also saw further expansion with a wide range of enterprise customers, including a leading software design platform and a large telco operator in the US. Our reach now extends into the public sector, a market with unique performance and security requirements. We recently launched CoreWeave Federal to bring our cloud services to the US government agencies and the defense industrial base. Already, NASA is leveraging our services to advance scientific exploration at its Jet Propulsion Lab. We are honored to help strengthen America's AI infrastructure, enabling agencies to accelerate innovation and address critical missions and our national interests. These recent wins underscore that we are enterprise ready. With our customer base broadening across verticals and geographies, we are excited to welcome John Jones as our first Chief Revenue Officer. John joins us from AWS, where he served as Global Head of Startups and Venture Capital. John is a strong addition to our team and will play an important role scaling our global revenue organization and driving expansion through this next phase of growth. Next, as I move to discuss our growing data center footprint, I want to briefly touch on our previously proposed acquisition of Core Scientific, which was terminated in October. While the deal made sense strategically for both companies, the valuation required by their shareholders was simply not a price that was appropriate for CoreWeave, particularly because the outcome of the transaction in no way adversely impacts our ability to achieve our growth ambitions in the coming years. Instead, we will continue to work closely with Core Scientific on the approximately 590 megawatts of capacity we have already leased. Our disciplined approach to expanding our capacity footprint ensures we are meeting the surging global demand for CoreWeave's cloud services. As I mentioned, we grew our contracted power capacity to 2.9 gigawatts this quarter as we diversified across size, geography, and developers, enhancing resilience and flexibility across our power portfolio. As of Q3, no single data center provider represents more than approximately 20% of our contracted power portfolio. In the past quarter, we added 8 new data centers across the US, strengthening our domestic coverage, with additional expansions underway across Europe, including a major new presence in Scotland, which is being developed in partnership with the UK government. And as we announced over the course of the summer, we have embarked on self-build projects to further accelerate our footprint and provide us greater operational control. While we are experiencing relentless demand for our platform, data center developers across the industry are also enduring unprecedented pressure across supply chains. In our case, we are affected by temporary delays related to a third-party data center developer who is behind schedule. This impacts fourth quarter expectations, which Nitin will discuss shortly. Having said that, the customer affected by the current delays has agreed to adjust the delivery schedule and extend the expiration date. As a result, we maintain the total value of the original contract, and the customer preserves their capacity for the full duration of the initial agreement, demonstrating the confidence they have in our ability to provide the most performance solutions in market. We are incredibly proud of our technical accomplishments, and our customers continue to tell us that CoreWeave is the absolute best place to run AI workloads.
CoreWeave down 5%.
In the third quarter, we continue to deliver many of the initial scale deployments of the GB200s, while once again being first to market, this time with the GB300s, further highlighting our incredible track record of operational excellence. CoreWeave's industry leadership is unmatched. We are the only cloud provider to submit MLPerf inference results for GB300s, setting the benchmark for real-world AI performance. And just last week, SemiAnalysis once again recognized our dominance, awarding CoreWeave its highest possible distinction, its Platinum Cluster Max ranking, for the second time, ahead of more than 200 providers, including the hyperscalers and emerging neoclouds. No other cloud has achieved this once. CoreWeave has done it twice, underscoring yet again that CoreWeave stands alone at the forefront of the AI cloud. Demand for AI cloud technology remains robust across generations of GPUs. For example, in Q3, we saw our first 10,000 plus H100 contract approaching expiration. 2 quarters in advance, the customer proactively recontracted for the infrastructure at a price within 5% of the original agreement. This is a powerful indicator of customer satisfaction, as well as the long-term utility and differentiated value of the GPUs run on CoreWeave's platform. CoreWeave is the world's first AI cloud at hyperscale, comprising compute, storage, networking, and software purpose-built for AI workloads. Our growing cloud portfolio is underpinned by an expanding suite of software and services that help our customers build, train, and deploy new products faster. In addition to mission control, our proprietary orchestration solution, which is critical to autonomously operate our AI cloud at the bleeding edge, we recently launched CoreWeave AI Object Storage, a fully managed storage service that eliminates any friction of moving data between regions, clouds, and tiers with zero egress or transaction fees. CoreWeave's AI Object Storage delivers the highest amount of throughput of AI workloads while cutting the customer's cost by more than 75%. We have already seen tremendous interest in this offering, adding a number of initial customers, including frontier AI labs like Mistral. Across our entire storage platform, we have seen rapid customer adoption, eclipsing 100 million in ARR in Q3. Combined with our unique global network backbone, purpose-built for AI, this positions CoreWeave as the hub for customers and their key AI workloads, enabling consistent, best-in-class performance and seamless user experiences when utilizing CoreWeave Cloud or a secondary provider. We've supplemented these capabilities with further expansion of our observability and security suites to ensure that CoreWeave is best positioned to handle all of our customers' critical workloads, regardless of the use case or geography. Our role over the last few years has been to support the pioneers who are developing and improving AI. Now we are expanding our role to help put AI to work. From the tools that developers require to build AI to the solutions that the physical world requires to adopt AI, we've used M&A as a key tool to accelerate this journey, including the recently announced acquisitions of OpenPipe, Marimo, and Monolith. With OpenPipe, we quickly integrated their solutions into our broader fine-tuning product suite and introduced the first publicly available serverless reinforcement learning tool. With Marimo, we are expanding CoreWeave's exposure to and impact within the open source community, starting with entry-level exploration and prototyping. Both OpenPipe and Marimo fit seamlessly with the capabilities of weights and biases, where we are rapidly growing the developer base reliant on CoreWeave's holistic platform. With Monolith, we are expanding these capabilities into the physical world to unlock the monetization of AI today, initially focusing on industrial use cases with an established enterprise customer base and mature workloads, including leading auto OEMs like Nissan and Stellantis. Through the rapid and successful launch of new products and services, we are expanding our addressable market and growing with our customers. We are fundamentally evolving the capabilities of CoreWeave, which is creating beachheads and expansion opportunities into new markets, all in the service of further supporting the rapid growth of AI and enabling AI builders and innovators to get to market faster and more reliably and drive ROI. Our engagements are getting more sophisticated, as evidenced by our partnership with CrowdStrike, which will unlock and accelerate partner-driven growth. Our new storage product and partnership with Vast Data is another example of accelerating both our product portfolio and partner go-to-market motions, and allows us to compete in new markets where we previously had limited or no offerings. This facilitates customer-driven platform adoption and product-led growth, creating tailwinds for our business. As I close, I want to emphasize what truly sets CoreWeave apart. We are the essential cloud for AI, combining unmatched technical and operational excellence with a rapidly diversifying customer base. We deliver the most performant infrastructure, the fastest time to market, and the most advanced capabilities in the industry. The world's leading AI innovators choose CoreWeave because we enable them to move faster, scale smarter, and achieve outcomes that simply are not possible anywhere else. Our momentum has never been stronger, and the opportunities ahead continue to expand. Powered by exceptional products, an extraordinary team, and unrivaled execution, CoreWeave is ready to enter the next phase of growth as a full-stack AI service provider and hyperscaler. The future runs on CoreWeave, and we are just getting started. With that, here's Nitin.
Thanks, Mike, and good afternoon, everyone. Our impressive third quarter results reinforce the relentless demand for CoreWeave and our focused execution.
Okay, so they're probably going to spend like 10 minutes going through the numbers. Stock's getting hit, guys. You guys said you heard guidance. I didn't hear guidance. Maybe I missed it. If anyone has the number that they heard, let me know. CoreWeave down 5%. It was down almost 7%. Hit 96.75. I have no idea what they said in terms of guidance. Maybe I just missed it, but there's got to be some number. Beyond Meat's down 3%. They missed EPS by about 20 cents. They missed revenue by, they beat revenue by 2 million. So they beat revenue by 2, missed EPS by 16 cents, 47 versus 31 on a loss. That's why that stock is down. And then the gross profit, 10.3% margins for Beyond Meat.
Demand remains robust for not just the Blackwell platform, but across our GPU portfolio. In the third quarter, we signed a number of deals for older generations of GPUs, adding new customers and recontracting existing capacity. The breadth of demand for CoreWeave's cloud services has enabled us to reduce our customer concentration significantly. Today, no single customer represents more than approximately 35% of our revenue backlog, down from approximately 50% last quarter, and even more meaningfully from approximately 85% to begin the year. Additionally, as of Q3, more than 60% of our revenue backlog is tied to investment-grade customers. This is what successful execution against our stated goal of platform and customer diversification looks like. Operating expenses in the third quarter were $1.3 billion, including stock-based compensation expense of $144 million. We continue to ramp our investments in data center and server infrastructure to execute against our growing revenue backlog, which contributed to the increase in our cost of revenue and technology and infrastructure spend in Q3. In addition, the increase in sales and marketing was driven by investments in marketing and scaling our go-to-market organization to capture the rapid growth of AI opportunities across enterprises and AI natives. The increase in G&A was driven by professional services and headcount. Adjusted operating income for Q3 was $217 million compared to $125 million in Q3 of 2024. Our Q3 adjusted operating margin was 16%. Adjusted operating income was better than expected due to higher revenue, lower costs due to timing of data center deliveries from our third-party partners, and improved fleet efficiencies. Net loss for the third quarter was $110 million compared to a $360 million net loss in Q3 of 2024. Interest expense for Q3 was $311 million compared to a $104 million in Q3 of 2024 due to increased debt to support the scaling of our infrastructure, partly offset by the benefit from better interest rates on our debt as we make further progress in lowering our cost of capital. Adjusted net loss for Q3 was $41 million compared to approximately break-even in Q3 of 2024, while adjusted EBITDA for Q3 was $838 million compared to $379 million in Q3 of 2024, increasing more than 2x year over year. Our adjusted EBITDA margin was 61%. Turning to capital expenditures, CapEx in Q3 totaled $1.9 billion, lower than anticipated due to the delays Mike mentioned related to deliveries from a third-party data center provider. The meaningful growth in construction in progress to $6.9 billion, an increase of $2.8 billion quarter over quarter, is a direct result. As a reminder, construction in progress represents infrastructure not yet in service and is excluded from CapEx until it is deployed. Now let's turn to our balance sheet and strong liquidity position. As of September 30th, we had $3 billion in cash, cash equivalents, restricted cash, and marketable securities. Growing rapidly and operating at scale demands a strategic approach to securing capital. CoreWeave has established itself as the leading AI cloud and the leading innovator in financing the infrastructure required to power the world's most advanced workloads for enterprises and AI labs. We continue to make great progress in strengthening our capital structure and lowering our cost of capital. In Q3, we amended the DDTL 2.0 facility by increasing its remaining drawable capacity by over $400 million to create a new $3 billion tranche at SOFR plus 425, which is significantly below the original cost of the facility. As we discussed previously, we also closed DDTL 3.0 in the third quarter, priced at SOFR plus 400, which represents a 900 basis point decrease from the non-investment grade portion of our prior facility. Going forward, we expect to continue to be able to finance at lower spreads as our capital providers increasingly appreciate our best-in-class execution, as well as the durable cash flow and visibility that underpin our take-or-pay customer contracts. Further, we raised $1.75 billion in senior notes in July, extending our exposure to the high-yield market at a cost 25 basis points lower than our inaugural offering in May. Year to date, CoreWeave has successfully secured $14 billion in debt and equity transactions to support our execution on our rapidly growing backlog and efficient scaling for long-term growth. Other than payments related to OEM vendor financing and self-amortizing debt through committed contract payments, we have no debt maturities until 2028. Turning to tax, in Q3, we recorded a non-cash tax benefit primarily due to the impact of one big beautiful bill. While the size of the impact to Q3 was one-time in nature due to a year-to-date catch-up, we expect the change in law to enable CoreWeave to realize cash tax savings in future periods. Now turning to guidance. As mentioned, the delays in powered shell delivery associated with the data center provider will have an impact on our fourth quarter results. These delays are temporary, and as Mike noted, the affected customer has agreed to adjust the delivery schedule to preserve their capacity for the full duration and the total value of the original agreement. With that backdrop, we now expect 2025 revenue in the range of $5.05 to $5.15 billion. In addition, we anticipate 2025 adjusted operating income between $690 to $720 million and expect to end the year with over 850 megawatts of active power. In Q4, we will be bringing online some of the largest scale deployments in our company's history. This will have a near-term impact on adjusted operating margin due to the timing difference between when data center costs are first incurred and when we start recognizing revenue. We expect 2025 interest expense in the range of $1.21 to $1.25 billion, driven by increased debt to support our demand-led CapEx growth, partly offset by an increasingly lower cost of capital. Moving to CapEx, we now expect 2025 CapEx in the range of $12 to $14 billion. We expect this reduction in CapEx from our prior guidance will be mostly reflected by a corresponding increase in construction in progress due to the buildup of infrastructure waiting to be deployed following the delivery of powered shell capacity. As such, the vast majority of the remaining CapEx we had previously anticipated to land in Q4 will now be recognized in Q1. In addition, given the significant growth in our backlog and continued insatiable demand for our cloud services, we expect CapEx in 2026 to be well in excess of double that of 2025. These investments in our infrastructure platform will strengthen our competitive moats and support our continued hypergrowth. In closing, we delivered a record third quarter and remain more confident than ever in the long-term trajectory of our business. Over the course of this year, we've made tremendous progress, accelerating our revenue backlog growth that now exceeds $55 billion while diversifying our customer base, executing strategic partnerships and acquisitions to strengthen and broaden our platform, accessing new capital pools that meaningfully reduce our cost of capital, and scaling both our capacity and organization at an unprecedented pace. This progress enables us to seize the opportunities in front of us today and create a strong foundation for years to come. Our addressable market continues to expand, not only as AI adoption proliferates across industries and use cases, but also through deliberate business decisions we've made to broaden our product portfolio and capture greater wallet share across the industry. CoreWeave is reaching escape velocity, scaling more rapidly and efficiently, and solidifying our leadership as the essential cloud for AI. Thank you to our investors and analysts for your support and engagement. We look forward to updating you on our progress in the quarters to come. With that, we move to Q&A.
All right, questions.
As a reminder, to ask a question, simply press star followed by the number 1 on your telephone keypad. We respectfully request that you limit questions to 1. And our first question comes from the line of Mark Murphy with JP Morgan. Please go ahead.
Thank you, Michael. Yeah, every discussion we have across the AI landscape, we hear that bookings are booming, and obviously that applies to CoreWeave. But the bottlenecks around power and manpower are just becoming so severe. Can you speak to that situation relating to the third-party provider? Specifically, is it a shortage of power or manpower? Is it something outside of that with GPUs or memory or storage? And then have you spoken to your other third-party providers to get a sense of their own trending, relative to schedule, and whether they think they can, hold on their or deliver on their commitments into early next year?
Let me kind of take that question apart a few different ways, right? So first of all, you're correct. It is very frustrating for our clients. It's very frustrating for us because of the kind of systemic challenges that exist within the supply chains that are necessary to deliver, the global infrastructure that's required for artificial intelligence. Having said that, we have taken a number of steps along the way here to really drive home our ability to manage that environment, which is going to be challenging, into the future. We've really spent a lot of time diversifying our data center providers. We have created a significant portion of the company dedicated to being able to facilitate and assist with the operational component of delivering infrastructure. We've set up our own self-build efforts, including Kenilworth and Lancaster, Pennsylvania. So you see us kind of really spreading out and ensuring that we're doing everything that is possible to limit the damage associated with, or the delays associated with, delivering this infrastructure, which is just overwhelming the supply chains. Now, when you have a diversified portfolio of paths to infrastructure, the relative impact of each delay becomes smaller. You just be able to draw on different data centers as you're getting it delivered. And so we really look at this as this is a significant block of infrastructure that's come on late, but the fact that the ultimate end customer that's going to be consuming this infrastructure has shifted the contract back to allow us to be able to deliver the full contract value in spite of the delays, really speaks to the value that the customers get out of our infrastructure. So, you're going to be hearing this theme repeated again and again as you talk to not just CoreWeave, but you talk across the space. And it is a real challenge at the powered shell level. It's not a challenge for power, right? There's plenty of power right now, and we believe that there will be ample power for the next couple of years. But really where the challenge is the powered shell.
And so Michael, does this not relate to Core Scientific in any way, or is this totally removed from that situation that you've gone through?
So I'm not going to speak to any specific one of our data center providers. We're working with all of our data center providers to do everything we can to facilitate the ultimate delivery of the infrastructure that they're going to deliver to us. We've had some incredible success getting infrastructure delivered to us as you continue to see us scaling. You saw us hit 500, approximately 590 megawatts. We're up 120 megawatts since the last call. So you are seeing a significant amount of success as we continue to scale delivery. But I don't think it really matters who the individual data center provider is. This is a systemic problem that the industry is going to have to deal with for the foreseeable future. The important part here is that, or the important part from my seat is that the infrastructure, which is undergoing a delay, is not going to impact our backlog and our ability to extract the full value from the contracts that we're going to deliver on.
Our next question is from the line of Keith Weiss with Morgan Stanley. Please go ahead.
Excellent. Thank you guys for taking the question, and congratulations on another super impressive quarter in terms of building out that backlog. You're right. We've never seen this in terms of any cloud provider being able to build out that quickly. Mike, I wanted to ask you a question that's been asked of us a lot, that we're hearing a lot on CNBC, and it's really about sort of the risk of overcapacity. But I think it's more narrow than that people are worried about overcapacity from of what's being contracted by AI labs out there. The question I want to ask you, though, is how we should think about your guys' infrastructure and the infrastructure that you build and how fungible that infrastructure really is. When you're building out for a particular customer, do those data centers, is that usable for any customer? Is it usable for inference and training? Or do you really build to suit to a certain customer that would lock you in and give you kind of less degrees of freedom, if you will, if one customer is doing better or worse?
Yeah, Keith, that's an excellent question. It's actually something that we've spent a lot of time thinking about here as we kind of proceed with our relationships with all our customers. And so, in short, the infrastructure is fungible. It would be able to be transferred from one client to another. The infrastructure is built to the most demanding specs, so it's able to be used for training. It's able to be used for inference. We really have thought a lot about making sure that we maintain as much optionality, as much flexibility within our infrastructure build as possible. And I want to highlight for everyone that a lot of that flexibility, a lot of that fungibility really does tie back to the incredible software suite that we provide that allows for such effective use of the infrastructure, right? Like when Sammy Analysis did their annual kind of review of the alternatives out there, there's a reason that CoreWeave has come back time and time again as singular, as the best solution for this type of infrastructure that exists in the world. And that includes the hyperscalers, the neoclouds, and everyone else that's trying to deliver this infrastructure. We just do a great job, and we believe that there's a lot of value that we are protecting by providing such a robust software suite to be able to deliver infrastructure.
Our next question comes from the line of Kash Rangan with Goldman Sachs. Please go ahead.
Hi, thank you very much, and impressive backlog growth. Two things that I wanted to just touch upon. One is, Mike, I think you talked about how you're going to be diversifying your contractors on the data center side. Maybe you could give us a honest to goodness update on how far are we away from potentially reaching a point where any disruptions that have nothing to do with your business should not affect your revenue outlook. How far away are we from that point? And secondly, when you look at the developments, I mean, nobody expected maybe some did, but a $250 billion contract for OpenAI with Microsoft, nobody expected a $300 billion contract for OpenAI with Oracle. All of a sudden, certainly CoreWeave has got a unique value proposition, being able to stand up GPU clusters very quickly, very effectively, at the speed of thought almost. But in a landscape where we're talking hundreds of billions of dollars being awarded to the hyperscaler giants, what gives you the uniqueness 3 to 4 years from now when things have sort of settled into a supply equals demand? When we look back at CoreWeave, what will be the shining value proposition that keeps you in the game at that point? And thank you so much, and that's it for me.
Yeah, thank you. Let me break that question into two pieces, right? The first question you asked is, about diversification and when does it start? When does it stop kind of causing dislocation in our numbers as we're delivering them quarter to quarter? And what I would like to focus you on here is, as the individual builds become smaller relative to the size of the entire portfolio of data centers that we are running, the impact of being a couple of weeks late will become less and less meaningful in the general accounting of what's going on, right? So when you're delivering 590 megawatts of power and you have a step function of 200 or 300, it's a material percentage that's going to be delivered over the next quarter, right? As we become larger and larger and start to build out the full 2.9 gigawatts of power that we have, having a data center that's 100 megawatts delayed a week or two is not going to have a material impact. And as Nitin said, we expect the overwhelming majority of that 2.9 gigawatts of power to be brought into service over the next 12 to 24 months. And so that'll give you a really good idea of how the curve begins to become more smooth as we get larger and the relative impact of each data center becomes smaller. And so that's the first part on the scaling side. The second part is, the question you're asking has been asked of us since we started this business. Why is CoreWeave going to be able to deliver GPUs faster? Why are we going to be able to deliver the GPUs that NVIDIA uses to run its ML perf? Why are we going to be able to create software that is going to define the space? And with each quarter, you see us extending the lead with which we have because of the customization of our cloud to the use case that is required. And once again, you saw us in the semi-analysis, like we're singular in this. We're out there building our product offering. We're building or buying additional capacity to further decommoditize the compute that we're delivering. And so, a company that's built singularly to deliver this type of compute will be effective on a go-forward basis.
Our next question is from the line of Amit Daryanani. Please go ahead.
Amit, are you on mute?
Amit, your line is open.
I'm streaming, guys.
Operator, let's go to the next question and we'll come back to Amit.
Yeah, I'm streaming. The fuck?
Come on. Operator, can we go to the next question and we'll come back to Amit?
Our next question is from Tyler Reck with Citi. Please go ahead.
Hey, hopefully you can hear me okay. Thanks for taking the question. So double clicking on some of the delays that you called out in the quarter, can you just help us understand the implications on 2026? I know, Nitin, you provided some high-level commentary on CapEx, but I mean, just given the visibility you have, particularly on the 24-month component of RPO, how should we be thinking about sort of the revenue implications of this shift? Is this a delay that you think kind of gets fully resolved into Q1? And should we see sort of a step up in growth rate next year relative to this year? Just any color on that would be helpful.
Yeah, so I'll start, then I'll hand it over to Nitin. I think it's important to understand that the ramp that we are seeing is associated with the infrastructure from a single provider. And we are parallel pathing with other providers for other contracts. And so you're going to see a short-term impact associated with this delivery. And then what you're going to see is our ability to accelerate through the year back to schedule. So the overwhelming majority of the delay that you're seeing should be taken care of within Q1 of next year.
Yeah, Tyler, that is correct. The vast majority of the CapEx push out that we experience in Q4 will be done in Q1. And as you can imagine, we're going to ramp the capacity through the course of Q1 for this. As Mike earlier mentioned, the impact on the total revenue associated with the customer is not impacted here because we've been able to adjust the delivery dates associated with the customer so that the customer keeps the full capacity as well as the contract value associated with it. We will share more details around the 2026 build, and our revenue plan associated in the next earnings. But as we highlighted in this quarter, given the strong customer demand that you see, given that is demonstrated in our revenue backlog growth, as well as the continued customer demand we see, we expect 2026 CapEx to be well more than double of that of 2025.
Our next question is from the line of Michael Turrin with Wells Fargo. Please go ahead.
Hey, thanks very much. I appreciate you taking the question.
I want to just try to tie some of the commentary together because the bookings growth clearly stands out, and there are a lot of questions just around the sequencing. And so it sounds like what you're saying is the supply chain impacts you're seeing are more single customer specific. What I'm trying to get a better sense of is, does this at all impact the cadence at which you're able to sign on new customers, or is this more tied to post-ramp signing and one more specific customer environment? And just as a small follow-up, does the NVIDIA deal specifically show up in the backlog metric? It might be useful to hear you expand on what that deal opens up, given it's a bit of a different structure there as well. Thanks very much.
Sure. So there is no impact on our ability to bring on more clients. I think it's important to understand that we're parallelizing the build of infrastructure. There is a problem at one data center that's impacting us, but there are 32 data centers in our portfolio. All of them are progressing to one extent or another. And so that is, each one of those is independent. And as Nitin spoke earlier, we have 2.9 gigawatts worth of contracted power that will come on in the next 12 to 24 months. And we are going to be looking to fill that with clients that are going to be using that, which will have a substantial impact on our revenue on a go-forward basis. This one data center will catch up, and then we will move forward from there. You want to talk about the NVIDIA deal?
Yeah, Michael, on the NVIDIA deal perspective, we're really excited about this deal. This contract allows for the capacity contracted and reserved for NVIDIA to be interrupted and resold to different customers. So the nature of this contract allows us to offer our services profitably to a wide range of smaller customers, such as high-growth AI labs that prefer shorter and lower upfront commitments, while eliminating any utilization risks for capacity from our side. So we're really excited about this. Given the flexibility in the contract to interrupt and to resell capacity, accounting rules require us that we exclude the amount we expect to be resold to other customers from RPO. To be clear, if not resold, this capacity will remain committed to NVIDIA and will be recognized as revenue. So you see this NVIDIA contract in our revenue backlog, but not in our RPO to a large extent.
So just to follow up with that for a moment there, as Nitin said, we're extremely excited about this, because what this contract is going to allow us to do is to provide infrastructure to emerging companies, startups, companies that are struggling to get access to the computing infrastructure that they require to be able to build their business. And so the interruptibility here is an incredibly powerful tool for the resiliency and opportunities for new companies to become part of CoreWeave's broader offering. And we're really excited about this. We think it's a great structure. It is a deal with NVIDIA. They fully underwrite the economics because we will sell the compute to them. And I want to be clear that this really does represent an incredibly disciplined way of financing the compute in order to be able to reach parts of the market that we have been unable to reach, or anyone for that matter has been unable to reach up to this point.
Our next question comes from the line of Brent Thill with Jefferies. Please go ahead.
Then just wanted to be clear, you cut CapEx by 40% for the year. And just to be clear, this is from one customer, correct? You're not assuming other delays across the board, correct?
That is correct. So this is associated with a single provider, data center provider partner, and the delays associated with that. And as we talked in our prepared remarks, most of it, a vast majority of it, is going to be recognized in Q1. And in Q4, you're going to see a major impact on buildup of construction in progress associated with the buildup related to it.
Okay, terrific.
And our next question comes from the line of Raimo Lenschow with Barclays. Please go ahead.
Perfect. Thank you. As we think about CapEx next year, Nitin and Michael, can you speak as well about the sources of funding a little bit? Because what we've seen for a lot of the other players is that leasing is coming up a lot more. You talked about CapEx, which is kind of what you need to do. How do you think about that path for you going forward between the different ways of kind of funding the business, which might give you even more flexibility? Thank you.
Thank you. So, look, we've driven innovation on the technology side, and we've driven innovation on the financing side, right? The way that I look at this is that we will look at the full suite of potential ways of financing and expanding our footprint. And then we will choose whatever is the most cost-effective way of increasing our scale and serving our clients. And so if leasing is the path, that's the path we'll go. But, you know, we've seen a lot of different structures. We've created a lot of different structures that have given us access to capital over the past 3 years. And, you know, we believe that we're going to explore the full suite of those as we look forward. We don't sign customers without knowing where the financing is going to come from. You know, we go deal by deal, and we make sure that we have the physical data center spoken for, we have the power spoken for, we have the GPU spoken for, and we have the financing spoken for in order to ensure that we are able to successfully deliver compute to them.
Our next question comes from the line of Amit Daryanani with Evercore. Please go ahead.
Yep, hopefully this works better.
We got you.
All right, perfect. Mike, I was hoping if you could just talk about as you shift from, you know, third-party data center providers to perhaps doing more of your own self-build, how does that impact your CapEx and time to market for power as you go forward? We'd love to just understand how do you think that optimal mix looks like and what the CapEx requirements could be as you perhaps go more towards self-build versus third-party data center providers. Thank you.
Yeah, so I want to be clear. We're not saying that we're going to go self-build and not use third-party data center providers. What we are saying is that self-build is a component of the way that you go about de-risking delivery across the broader portfolio. And so we're going to go ahead and we're going to continue to work with our partners who provide data center capacity that allow us to co-locate at their facilities, that build facilities for us. All of that is going to continue to be true. We need that capacity in order to be able to continue to move and operate at the speed and scale that we are. We just look at self-build as an additional piece of the puzzle. It puts us closer to the physical infrastructure. It embeds us deeper into the supply chain around the world so that we have firsthand information. We just think that you need to be on both sides of this fence in order to be as effective as you can be, de-risking what is a complicated supply chain environment.
Our next question comes from the line of Brad Zelnick with Deutsche Bank. Please go ahead.
Great. Thank you so much for taking the question. Mike, with 2.9 gigawatts in committed power and over a gigawatt yet to be contracted out to customers, meanwhile, we continue to see a number of other large deals get announced industry-wide. How do you think about, and how might you frame for us, the pacing on contracting out the remaining capacity, given the demand is insatiable out there?
Yeah, so look, thanks for the question here. The fact that there are other deals getting contracted out there is incredible validation for the supply-demand environment that we have been describing for years now, right? There is no entity that has the capacity to be able to deliver infrastructure globally in order to meet the demand that's being driven by the largest technology companies in the world, by the largest AI labs in the world, by government, by enterprise. All of these things are coming to bear. And so the fact that there are other deals going to other players is part and parcel for the fact that we, like the hyperscalers, like the AI labs, like the data centers, are being overwhelmed by demand. It is just reinforcing and validating the theme that we've been talking about. We think that, you know, at the end of the day, the product that we deliver, right, which is a full stack, everything from the hardware all the way through the software, is the most valuable representation of this infrastructure that can be delivered to the market. And we continue to think that that will drive a significant amount of demand for our infrastructure. As far as the remaining capacity goes, we're being very thoughtful about continuing to drive diversification across our cloud. We're continuing to think about different applications that are going to be meaningful contributors to the way the world will work in the future. And we are allocating that infrastructure to those parties as quickly as we can in order to ensure that they are successfully able to launch their products, their enterprises.
And Brad, a couple of things to kind of keep in mind here as we kind of talked about in our prepared remarks. Today, you know, approximately no customer represents greater than approximately 35% of our revenue backlog, which is meaningfully down from, you know, where we began the year at 85%. And 60% of our revenue backlog is with investment grade customers. So vectors that we are very thoughtful around as we take care of the capacity that we have available to be sold.
Okay, guys, I think that's pretty much it. I think they have like 1 or 2 questions left. But that's it. We are done. I don't know that much about CoreWeave. I just know the call was like, it just felt like they were defensive the whole time, and not in like a Sam Altman type of way. It wasn't like they were getting confronted with any hard questions. It was just like, it didn't feel like they were super optimistic about the future of their business in relationship to data centers. Now the numbers are phenomenal. So, you know, this might be just like a thing I'm nitpicking with how I heard the call go, but the numbers were great. The issue with, I think why the street has it down is because the CFO said many times, you guys felt that too, right? A lot of you guys saying defensive. Yeah. The CFO said many times, we are going to further increase our debt load to finance our demand-based CapEx. Now, the reason he's using that word demand-based CapEx is very intentional, right? He's trying to say, hey, the reason we're taking on more debt is because we have so much demand, which is fine. It's just at the end of the day, that might not be something that the street cares that much about, or that the street may want to see. Now, granted, they're taking on more debt, but they're 22 cents away from profitability. So the debt might not be the outstanding cause for why they don't continue to eventually get profitable. CoreWeave right here down 5.7. The guide they gave, I don't think it was a bad guide. It was relatively decent. I don't know the exact numbers the street wanted, but from my understanding, it looks like they're beating on revenue. They might be missing a little bit on not EPS, but non-GAAP operating income. But that doesn't look like a horrible guide. Rocket Lab's still up 7% after hours, so it looks like that call is going okay, not really giving up that candle. Big Bear up 12%. Rigetti is flat, even after a pretty big miss, so Rigetti not having that much pain. And then TeraWulf's up 2%. Even after a very large miss. Beyond Meat is down 5% after a bad EPS miss, a beat on revenue. Oxy's flat. Plug Power now goes red after a good beat. CoreWeave is the one that's getting hit the most after hours, down 6.1%. So I guess the big thing tomorrow is Nebius. Yes, I'll be covering Nebius. I'm not going to be streaming it because it's during the market open. I'm sure there'll be another channel that's streaming it. We will go through the numbers. And, you know, the thing about Nebius, again, I did my deep dive on them. I was saying this in the chat. I'm just a little concerned about these neoclouds not getting more deals. Nebius has been getting a lot of upgrades, though. Like a lot of upgrades. And I've been reading some of these reports. I think they got a $200 upgrade this morning. I forgot by who, but it was one of these firms. And every time I read the upgrade report, I look at my deep dive. I'm like, this is very similar to what I said in my deep dive in terms of the holistic perspective these analysts are taking on Nebius. Like the average price target right now in Nebius is 155 on the street. You know, 40% upside from what we have currently right now, and there's only 5 analysts, but still you are seeing Northland Securities. They were the ones that were 206, and then D.A. Davidson gave them to 150. But then again, I don't know if I know the business that well to say that before earnings it's going to be okay. So I think we got to see. I also think, again, there's some hiccups in this data center debt financing issue. And the one thing the market doesn't want to hear about is debt for data centers. And CoreWeave is explicitly saying we're happy to take on more debt because we have a ton of demand, which is fine. But I think the market doesn't love that at the moment, which could change tomorrow. I mean, these stocks are super volatile. Nebius right here, up a little bit after hours, 1.4%, as it continues to go green. So Nebius, CoreWeave, Iren had a pretty good earnings. CoreWeave, I think the numbers were good, even if the call wasn't the best. Iren right now after hours, that's up 1.6. CleanSpark getting decimated after diluting by $1 billion, back down to $14. Maybe the street doesn't care too much about it in a couple of weeks, but as of now, street's not the happiest. Opendoor up 3% after hours after the CEO tweeted he's going to be buying more stock. Rocket Labs up 7%. And he got CoreWeave down. After hours after the CEO tweeted he's going to be buying more stock. Rocket Labs up 7%. And he got CoreWeave.
All right, so here I'm gonna give you the link so you can go check out my video on Nebius. It's a pretty good video there. It's just a quick summary if you don't know what the company does. But overall, as you can see, CoreWeave, even though they reported really good numbers, the market was not happy. So it's about what? They're down by almost 6%. And most likely that's going to be due to the numbers that they are going to, there's around expenses. But once again, on the call, we can kind of confirm that they weren't really that confident in their numbers and really defensive as well. So that is the end of the call here. If you want, you can go to their site and grab their quarterly reporting. Their numbers look decently good here. You can see the revenues up. I mean, to have revenues go up over 134% for the year is pretty impressive. Revenue backlog. So there's still, as you can see, going into 2026, there's going to be significant amount of demand for what they're doing. But it was really interesting. The analysts were asking them questions around, all right, so how are you guys booking these new deals? Before you book them, are you making sure that you have enough data center and power and access to building out more of their infrastructure? Because that's going to cost them a lot of money. So I mean, if you believe that AI has like a couple more years before before it becomes a bubble, or if you believe it's just this is the start of AI, this company absolutely plays a very critical point in the growth and expansion of AI within the United States, probably around the world as well. And they have great partnerships. Like you got Johnson One, who has I believe they have a decent amount of shares in CoreWeave. Let me see if I can pull it up here. How much equity ownership does Nvidia have on CoreWeave? I think they have a significant amount of shares. So Nvidia owns approximately 7% of CoreWeave, and by the way, even though 7%, Nvidia CEO has come out and said, I wish we owned more than 7%. He really wished that they owned more than that. So that's a total of 24 million shares. That's about 7% ownership in CoreWeave. Valuation initially evaluated at $900 million in Q1 of 2025. $900 million investment now turned into an estimate of 1.6 to 3 billion, depending on market fluctuation, obviously. Strategic context. So Nvidia's stake is not just physical, a financial. It's also a vertical integration strategy. CoreWeave is a major customer of Nvidia's, so they buy this is why I'm saying like the relationship between NVIDIA and CoreWeave is pretty tight, because NVIDIA makes the parts that CoreWeave needs, and then obviously CoreWeave has the data centers that AI customers need to do their businesses, and as well as customers around researchers, developers, customers like Meta, and so on and so forth. And also a lot of startups are going to need some compute, and so for inference, so that they're going to partner up with a company like AMD, like CoreWeave. So boom, you got the H100, A100, GH200. These are all the ones GPUs that NVIDIA has. By owning equity, NVIDIA embeds itself deeper into the AI infrastructure stack. The investment was anchored during CoreWeave's IPO, with NVIDIA's reporting placing about 250 million order at $40 a share. Applied Digital, so companies to compare to other stakes. So across the board, so these are other like maybe AI plays and Nebius, other AI plays that NVIDIA has decided to invest in. So it looks like here they have a CoreWeave, they have 7%, which is about 24 million shares. So Applied Digital, looks like they reduced the number of shares. ARM, 1.1 million shares. Recursion Pharma, 7.7. Nebius, minority stakeholder, and WeRide, minority stakeholder. So these are so when you're buying a company like this, like CoreWeave, you can already assume that like you kind of have a really good backstop, because you have an amazing company that is about $5 trillion kind of backing up the business like CoreWeave. So I think, I don't know if you're gonna get in this. It looks like they are getting beat up after hours. I mean, look how much is CoreWeave down right now. CoreWeave is down almost 5% after hours. I don't think their numbers are that bad at all, but it looks like the market did not like how the earnings call went. Finally, looks like they're below 5. Wow. The market just did not like that. The CEO wasn't just so confident, and it seemed like they were being very, very defensive during the call. Tomorrow's earnings. So these are all today. So Rocket Lab, CoreWeave, Rigetti, STS. I think they probably reported decent earnings. Jeez, no, this is the one where we said it would be terrible. Yeah, we kind of saw this coming, that this company is slowly doing better, but like we saw their earnings isn't going to be as good for ASC Space Mobile. They missed EPS at 95%, revenue at 31%, and it's just standard for them to miss. But the market didn't beat them up too much for it. It looks like maybe it's what they expected. Most of the time, what happens when companies like these that are kind of paving a new segment in the industry, you don't really expect them to make revenue and all this margins, but you expect them to continue to grow and gain market over time. So it's not a bad thing that they're missing some of these numbers at all. But if they're moving backwards significantly, it's going to be really, really bad. Yeah, these type of companies become more of like research and development companies that are paving a new map. So who do we have here tomorrow? We have another big company here. They're going to be reporting, Nebius, in a pretty similar position as CoreWeave. It looks like they reported last couple quarters. The numbers look pretty clean here. They seem to be historically beat earnings. Historically they have been doing really bad on earning reports. But Q1 and Q2 of 2025, they have been beaten. They've been beating pretty well. So that is good right here. So EPS, they beat by 11.82, and then Q2 they beat by 9.52%, but then Q1 of 2025 they did miss on this revenue. They beat it in Q2, and on my assumptions, I think they're gonna have pretty decent quarters, unless the market is gonna take them down for some of the same reasons that they're taking down CoreWeave for. So that's gonna be really a pretty good earnings to watch out for. But CoreWeave Nebius overall after hours doing a pretty good here. They're up about 1% after hour. During the day they did take they're down about 1.2%. And then say this is 0.76 billion expected. EPS looks like they missed EPS. Wow. So EPS continues to go up, and our expectations continue to go up, but looks like the company isn't meeting those expectations at all. Revenue's also kind of all over the place, but they've missed here and there. So the Q1 at 25, they did miss on revenue by 1%. Okay. Yeah, they're having a really hard time getting that EPS close to expectations. And then after hour, okay, I can tell you now, this company is gonna dump. Like, it doesn't make sense why a company that doesn't even have one product in the marketplace, if they're a power company, they need to be able to actually generate power, not just promise that they'll have power by 2026. So if we look at Oklo, does Oklo have products and revenue? Not review. Damn. So this is a company that is supposed to be in the power industry, and Oklo does not have any commercial products available, but it has received a positive review. Listen, positive review. This is a company trading at market cap of almost $17 billion, and they have no product. Nice statement. So here we go. So this is a company that's making a revenue of $0. At the end of the day, they lose money. There's no EPS because there's no money. Cash equivalents not disclosed in the summary. Research and development expected to be high. Shares outstanding, 139.2 million shares. Oklo remains in pre-revenue development, focused on building its first Aurora microreactor. The company is investing heavily in regulatory approvals, engineering, and partnerships, including DOE site licensed in federal support advanced nuclear deployment. Why would I invest in this company when they have nothing? All this is just a promise for one day. When will, I think it's 2027, when will they have, when will they start generating power and selling? So Oklo Oklo expects to begin generating and selling commercial power for its Aurora micro reactor by late 27 or early 28. So you're telling me I'm going to sit here and wait for this company to start making power 27, 28? That's more than 1 year away. And then that means like you're going to miss on a whole bunch of other opportunities and take a risk on a company that doesn't even make one penny. All they have to their name is that maybe you have Sam Altman, the CEO of OpenAI, used to be on the board. And he left because due to like a conflict of interest, because he he needs power. He is an AI company, so he's not allowed to be on both teams. So that's literally what they has going on for itself is that Sam Altman is on the team. So Oklo is currently in this prototype phase, and they're designed for 15 to 75 megawatt output. Regulatory milestones: Oklo completed phase 1 of its readiness assessment with U.S. Nuclear Regulatory Commission, NRC. A revised combined license application for 75 megawatt reactor is expected Q4 2025, leveraging Department of Energy authorization and reduced fees for advanced reactor application. And they're going to build this from the ground up, by the way. It's not like they're renovating something that exists. Nope. If we try to find Oklo site location, it's going to be ridiculous because maybe I should have done that here. Oklo site location. So this is their site. They literally have one spot. So location, they got Oak Ridge, Tennessee. Purpose: Advanced Fuel Recycling Center, Idaho National Labs, Aurora Powerhouse Prototype and Fuel Fabrication. And then they got Ronan County, Tennessee, anchor site for fuel recycling and future deployment. Public-private partnerships, site characterization approved, and then selected in September 2025. So this is the promise is that you have a website and no product. Begins site characterization work at Idaho National Labor. But all this means nothing, and until they just start digging, actually start digging and buying the parts and actually developing. Right now it's just nothing but all just promises. So this is why I think sometimes investors are being stupid and investing in companies they don't really even know or push the wrong stock. So that's tomorrow. Circle, we'll get into Circle International Circle Internet Group. They're reporting their earnings. Looks like on Wednesday. These numbers are going to be really big. It's going to impact crypto companies. So it's going to be interesting to see what goes on here. I think that is all for now. What I'm going to do is I'm going to keep Yahoo Finance playing here. Director of Equity Research, kindly on. So let's watch this real quick.
With CBS, and Paramount does own other local TV stations. It looks like the Trump administration will be kind of the lever to kind of open up these kind of restrictions. But certainly there's going to be some review of any merger of this size. The question is, would it be the FCC or the Department of Justice?
Ken, let's switch gears here. Looking ahead, you got Disney earnings on deck. That's another name you cover, another name I know you like. What are the key metrics you're watching for in that print, Ken?
Yeah, so we have a target of 135. The stock has kind of dripped down to like 111. We're seeing pretty good execution, as it relates to Disney Plus. So we want to see more positivity there in terms of their ability to generate cash flow earnings. The parks seems to be fine, particularly in the U.S. because the U.S. economy is still growing, and the experience segment, which we have parks and cruise lines, seems to be an area that should generate good single-digit earnings growth. And then, of course, when we look.
Yeah, all right. That is Disney numbers. I think Disney is reporting this week. That is right here on Thursday. So these numbers will be important. Once again, we're going to be looking at what commentary they're going to make on Fubo TV. Um, but that is all for me for this for today. Make sure if you're not subscribed, go ahead and subscribe. I'm going to be posting videos like this more often, and I'm going to be covering finance, stocks related. If you have any ticker symbols that you want to talk about, go ahead and leave it in the comments. If you're not subscribed, make sure you go ahead and subscribe. I'm out of here. We just covered CoreWeave earnings. I left a comment there. That link should take you to their Nebius's analysis. That's the companies and what they do. So that's a really good overview video. So when we finally see earnings tomorrow, you're gonna have a really good understanding of what the company does. That is all I got for today. Make sure to subscribe. I'll see you tomorrow or maybe later tonight. Peace.